Hi everybody, welcome. My name is Jason Heath. I'm your host and this is the Objective Financial Hour. We're here today talking about insurance, and in particular it's disability insurance and critical illness insurance we're going to talk about today. I find that a lot of the attention within the industry is paid to life insurance, but there are other types of insurance that are equally and perhaps even more important, and that's our hope to educate you a little bit today. I'm here with Chad Larmond of Larmond Risk Management Insurance, Inc. He is the principal of the company and has been around a while in the industry. His father was also in the industry, so sort of grew up in the industry in that regard. And one of the things that I've often found, Chad, over the years when it comes to working with clients, talking to clients, a lot of people sort of have it in their heads, I think, that an insurance salesperson is sort of the old-fashioned door-to-door insurance salesperson that they're not necessarily looking to chat with and spill the beans to, so to speak. But I think the profession has changed a lot over the years. One of the things that you've really struck me with is the fact that you're very professional and you're more the type of insurance person that I think clients would like to talk to. Yeah. So what's your background in the industry? Your father started off in the insurance industry some time ago, as I understand?
Yeah, well, first of all, thanks for having me. Going back, I guess, to my father's history in the business, started with a company called Mutual Life, and that company's evolved, but he's been in the business for about 35 years, and I've seen him kind of grow.
And Mutual Life, was that one of those big insurance companies that eventually morphed into another insurance company, presumably?
Yeah, it's kind of typical of how the industry has gone. It's now under the banner of Sun Life. Okay. And like I said, he's been doing it for a long time and helping clients, and I've seen him kind of develop good client relationships, helping clients both on the investment side, but very much so on the life insurance side of things.
Okay. And so you've not been involved on the investment side of the business before. You've been strictly insurance over the years, and as far as your history and your past?
Yeah, strictly insurance. So when I was coming out of university, I had took a business degree there. Wasn't sure kind of what career path I wanted to take, but my father encouraged me to maybe start with a big company, get some experience, and then eventually, which I did. So I started with a company called Unum Provident.
Okay.
Focused on disability insurance, critical illness insurance, and long-term care insurance. And then shortly thereafter, being hired, it was purchased. The Canadian division of that company was purchased by RBC Insurance.
Okay.
So I spent approximately 8 years with the combined company Unum Provident and RBC Insurance. And then more recently, in the last couple of years, have gone out on my own as an independent broker to help clients directly.
Okay. And so just to get back to what I was saying earlier on about sort of the perception, I suppose, that some clients have of people in the insurance industry. I mean, I'm a financial planner. I don't sell investments. I don't sell insurance. But a lot of people, they hear financial planner and automatically that's what they perceive. So I'm not a big fan of telling people that I'm a financial planner, advisor. I don't know what the right word is. I usually just tell them I'm a father or something. That's sort of a better, can't go wrong there. But again, I've seen things change over the years, and certainly the people that I see in the insurance industry are an awful lot more professional than I think they were. Standards have increased as far as education, as far as ongoing requirements and whatnot, but you still find some pushback from people that clients hear insurance and it's like, oh geez, I already pay too much home insurance and car, and what do I need more insurance for? Do you get that sort of pushback?
A little bit sometimes. I think the best way that I found to build my business is by referral. Trying to do a really good job for people, following through on the promises that I make, and as my associate and I always joke, it's really about education and educating people about their risks, and then also the different ways to purchase insurance in the Canadian marketplace, and making sure they make sound decisions with insurance, because it is really important. I always talk to clients about you insure your home, your car, but a lot of people, don't necessarily think about the fact of insuring their health and their ability to earn income. And that's what, these products that I specialize in, disability, critical illness insurance, are designed to provide that safety net in the event that their health goes south for a short period of time or an extended period of time.
Now, there's two things that you said there that I found very interesting, and I guess it sort of goes back to the name of your company. It has risk management in it.
Yep.
And at the end of the day, that's what insurance is. It's risk management. It's something that I think a lot of people in the business world are used to paying attention to. Risk management is important for a corporation. Risk management is very important for an individual.
Yep.
And at the end of the day, that's what insurance allows one to do, is to manage risk, manage the unforeseen. It's kind of like, much the same way you would manage the risk of dying by having a will when you do your estate planning. It's very important to do your insurance planning as well,
right,
and make sure you've covered off all the bases. But the other thing was about being able to search out the marketplace. You said something along those lines that suggested that you were able to source insurance from different companies.
Yep.
As opposed to some individuals who work for a single company and perhaps are only able to offer their company's insurance solutions. What's the difference between somebody that works for an insurance company and somebody who's, I guess, a broker and has access to different companies and different products?
Well, I mean, the first thing I'll say is that there's very high quality people in both, situations, whether they're working directly with one of the big companies or as an independent broker. So the real important thing is to feel comfortable with the person that you're dealing with. And that's kind of, the key consideration. But the reason I put myself in the position that I'm in is so that I can source the best product at the best price for the client's individual situation. Because, clients generally have similar needs, but there's always anomalies and differences within each client situation. Okay.
And do you find there's much difference between the types of products that are offered by different companies and the pricing?
On the disability insurance side, there's really, as we talked about, the history of the insurance businesses. Companies have kind of consolidated. Some of the smaller ones have kind of gotten folded up into the larger ones. So for professional disability insurance coverage today, there's really only 4 major carriers that offer that coverage. Wow. The underlying definitions and pricing options are very competitive and similar. But like I said, the most important thing is dealing with an expert that knows how to properly structure the underlying definitions, because if you don't have the underlying definitions structured properly, it can really leave you in a vulnerable position if and when you ever need to claim for benefits.
Mm-hmm. And so how did you end up making the shift and the focus towards disability insurance, critical illness insurance, and long-term care insurance? I mean, those, when I meet a new client, I tend to find that everyone's got life insurance, or most people have life insurance. And when I meet people that work in the insurance industry, everyone's a life insurance agent.
Right.
Why is it that these other types of insurance are not commonly owned and are not commonly specialized in by the industry?
So a little on my background. When I got hired into the business, I was hired as a specialist and wholesaler for the company that I worked with, and my job was to try to partner with successful insurance brokers and investment advisors that had their life insurance license to help them structure these living benefit products for their clients.
And by helping them, I gather that means to a certain extent educating them, because their focus and their specialty would have been on life insurance potentially.
Yeah, exactly.
So you're educating the
And a lot of what I did was not even getting into the nitty-gritty details of the policy details, but just encouraging them to show the clients that their greater risks are actually disability and getting sick versus dying, especially prior to the age of 65. So, it's funny though. I'm meeting with clients now, and I also do, some life insurance planning for my clients that have young families and businesses, and sometimes they'll have it in their head that they need to buy life insurance because they're having a child. And I always say to them, and sometimes they'll balk at the idea of insuring their income for disability or critical illness insurance. And I almost question their reasoning, because the more likely statistical event is that they're disabled for 90 days or longer, or they become sick with one of the covered conditions like cancer, heart attack, or stroke in a critical illness product.
Yeah, it's funny. I remember reading at some point a statistic about the likelihood of becoming disabled in a given year. Or the likelihood of dying in a given year.
Right.
And if you go along, from somebody into their 30s, into their 40s, I think it was around age 40 or early 40s where suddenly your likelihood of dying in a given year was the same as your likelihood of becoming disabled. But prior to that, in your 30s, when everyone's buying life insurance coverage because they're having kids, it tends to be that the disability is ignored, and it's more important, more likely to happen. As a result, more expensive, and not as many advisors, insurance agents, and specialists that are educated in it. So I think as a result, there's a lot of people that just avoid the conversation with clients, and avoidance isn't a good way to plan your personal finances.
No, and as you know, a lot of what I do is help clients that do have a company job, or they're an owner of a business and they're covered by a group long-term disability program. I help educate them as to some of the limitations that group plan has, and the advantages of structuring a personal plan to make sure that your income is properly protected and you can rely on the definitions of disability. And kind of going back to your comments there, a lot of it's getting more, I think it's becoming more relevant, but if you don't do it every day, it's difficult to keep up with. And if you're not comfortable with a client asking you a question about when do I get paid, when don't I get paid, I think that's why a lot of life insurance brokers tend to shy away from that conversation and really focus on life insurance and then permanent life insurance at younger ages, when I think for what I do with my clients, considering maybe term life insurance combined with the proper disability and critical illness is really the right thing to do with customers.
At the end of the day, I could see almost ending up being in the same price per month as far as your insurance premiums, but you're actually insuring the right kinds of risks. And I do certainly see a lot of people that are in whole life insurance policies or universal life insurance policies that probably shouldn't be, that haven't taken care of other areas of their finances, whether it's debt repayment or RSP contributions or disability insurance or critical illness or some of these other types. So I like what you do and what you're doing, and the fact that you are trying to help fill a gap that is left perhaps by an industry that is too much focused on a certain type of insurance. So we haven't talked very much yet about what disability insurance is, what critical illness insurance is, what long-term care insurance is. We're going to get to that a little bit later as we move our way into some of the other segments.
Sure.
Right now, we just wanted to talk a little bit, or I just wanted to explore a little bit about who you are, what you do, a little bit about the industry, to give a bit of an overview to clients. And I think that this has been a good start. So guys, I think what we're going to do is we're going to take a break, and we're going to come back and have two more segments as it relates to some of the different types of insurance that we spoke about. We want to educate you so that you can make sure you're making the right financial decisions. So we'll be right back. Hi everybody, welcome back. I'm Jason Heath. I'm your host for the Objective Financial Hour. We're here today talking with Chad Larmond of Larmond Risk Management Insurance. And we're talking about the insurance industry. We're talking about different types of insurance than perhaps you have already purchased or learned about. We're talking about some of the lesser known insurances, disability insurance, long-term care insurance, and critical illness insurance. And in particular in this segment, I think we're going to talk a little bit about disability insurance, just as far as what it is, who needs it, how you get it, how it works, all those sorts of things. So Chad, welcome back.
Thank you.
And I guess maybe just as a starting point, what is disability insurance? You know, I always hate to assume that people know what things are when you're going through the process of educating them financially. So what's disability insurance anyways? How's it work?
So disability insurance is designed to replace your income or a percentage of your income when you have an injury or sickness that you're experiencing that prevents you from doing the important duties of your job. Ideally, that's the definition that you're sourcing there. So, you know, when speaking about the need of disability insurance with my clients, you think about what, use an example, a 35-year-old earning $100,000 of income per year is going to earn between age 35 and theoretical retirement age of 65, which could be longer these days, but let's just say they do retire at 65. Between 35 and 65, they've got 30 working years there. At $100,000 of income, that's $3 million of income that they're going to earn in their lifetime. Mm-hmm. And really that's what you're protecting with disability insurance. The only thing that allows them to earn that income in the next 30 years is their ability to maintain their good health and continue to work. So really we start there and then kind of go into what the first part of the conversation that you asked me about, which is what is disability insurance? But really that's what we're protecting.
Okay. And so disability insurance kicks in if and when you become disabled and you're not able to work. What's considered a disability?
So good question. Anything that you can think of, a lot of clients throw scenarios at me and they say, Chad, what happens if I break my leg? And I need to be on crutches and what happens in that scenario? Well, if you're a white collar worker and you break your leg, it's likely that you can still do your job. Mm-hmm. So disability insurance is not designed to cover really the short term or things like breaking your leg, because you might still be actually working. For a blue collar person, that might be a different story. Mm-hmm. If they have manual duties, a broken leg could put them off of work. But then it's all about when does the contract kick in and how have you designed the program. The most cost-efficient waiting period in the industry before benefits actually begin. So you're disabled at day 0 or day 1. Insurance companies price it so that 90 days is the most efficient way to have that disability or the best price point, basically. Okay. So, part of disability planning is having some emergency funds there to float you for those few months that the insurance company isn't going to flow the money to you. So really, we're talking about things that are more serious than a broken leg, typically. Things that might be covered in a critical illness contract, but not necessarily, but things like cancer, heart attack, stroke, but car accidents, different things can happen that, and really what you want to do is transfer the long-term risk of disability, which is very difficult to replace, that $3 million number, mm-hmm. And transfer that risk to the insurance company.
So why don't we start with a scenario then? Somebody gets in a car accident. It's a very serious car accident. They're in a coma, blue collar, white collar, doesn't matter what. They're not able to work. What happens typically to somebody who is an employee and probably has group coverage somewhere? What would typically happen on day 1 in a case like that? Somebody use their sick days and disability insurance kicks in at some point, or?
Yeah. Well, within the group insurance world, they kind of separate disability insurance into 2 products. One is short-term disability, the next one is long-term disability. So a lot of employees are used to talking short-term disability versus long-term disability. And that's where some of the big companies would have a contingency or a plan in place to provide funds almost immediately,
Okay.
from the first day of accident or maybe 14 days after a sickness, for example. And then that would pay you for maybe 4 to 6 months. And then after the 4 to 6 months, it would switch over to the long-term disability.
And are there different tests as far as what dictates a short-term disability versus a long-term disability?
Not really.
Higher bar for long-term disability, or it's just disability that kicks in at
So
a certain point?
Yeah, it's really the timing, but the definition for short-term is typically very good. It'll pay you if you can't do the important duties of your occupation. And then when you shift to long-term and you still can't do the important duties of your occupation, usually for the first 2 years of a group, this is very typically stereotypical speak here, but the first 2 years of a long-term disability will pay when you can't do the important duties of your job. The problem happens after 2 years. The definition changes, and it changes to usually say you're only going to continue to get paid if you can't perform the duties of any occupation for which you may reasonably become fitted by education, training, and experience. So it's no longer can you do the job that you're doing today, Jason. It's the job that the insurance company, if there's something else you can do, the insurer has an opportunity to relook at the claim after 2 years.
That's interesting. So what would then happen? Would the bar be fairly low as far as an insurance company saying, well, no, you could go out and you could work such and such a job and you could make $20,000 a year instead of the $100,000 a year you were making potentially in your other job?
They use the language such as reasonably in that definition. Maybe the whole problem is you never want to put your client in that situation. There's so many different situations that we could run into from a health perspective. You don't know all the factors that might
you can never guess what's the disability
we
I'm
might
going
be
to
faced with, right? And if you can avoid the shift, I kind of call it a shift of control. So with a properly structured disability plan, the client and the advisor are more in control of that because the definitions are structured properly. So if you can't work, the money's going to
job
exactly the money's going to flow as it should. And then kind of the other part in the group long-term disability definition, typically, like I said, after 2 years, now that claim is now being reviewed by the insurance company, and that control is back in the insurance company's court. So, anything we can do to avoid that, with our clients is definitely a good thing. And we'll talk about the cost of these plans, but from a percentage of income perspective, clients that are making $100,000 a year might spend, depending on their age and gender, but might spend between 2 and 3% of their income to properly protect their income. Mm-hmm. The higher, more affluent clients that are making $250,000 or higher might only spend 1 or 2% or less of their income to actually properly protect against the risk of disability.
Okay. And so then it sounds to me like most employees in Canada have group coverage. And most, very generally speaking, have group coverage that would take care of them for the first 2 years. So even if somebody has group disability insurance coverage, and I've got to say, a lot of clients I work with, I ask the question, and they're not sure. They think they do.
Yeah.
But even if they do, there's still that gap from 2 years onwards in a lot of group policies. So most employees should be at least considering then a long-term disability policy to cover them after 2 years of disability. Is that fair to say?
That's fair to say. And the other thing I'll say is that a lot of group long-term disability plans, the typical ones that are out there, won't have a contingency to pay you part of the benefit if you can only work part-time because of your injury or sickness. And that can be a big problem because a lot of disability claims either start with a reduced ability to work, or when you come back to work after a total period of disability, you don't come back full time. You come back on a reduced capacity. And the individual plans can be structured with that partial contingency in it, whereas some group plans will have it, but many group plans will not have that.
Okay. And so how would that work then if somebody had some sort of a head injury or post-concussion syndrome, and they had been used to working a long 10 or 12-hour day, slugging it out as a commission salesperson or something along those lines. And all of a sudden they were only able to work 4 or 5, 6 hours a day because they got these horrible migraines.
Yeah.
So if they were in a position where they could go back to work after 2 years, but they could only work sort of at half capacity, then an additional disability policy could cover the difference to get them back up to what full capacity was?
Yeah, a proper individual disability plan, if it's structured properly, will have that contingency to pay a partial benefit when...
So you wouldn't be making the money that you were earning plus replacement of your income. It would be the combination.
Usually
would get you back up.
I mean, there's two definitions in the industry. One is if you can't work one half of the time that you were normally working, the contract would pay 50% of the benefit. The other is called, so that's partial, the other is called residual, where if you're losing 40% of your earnings, you'll get 40% of your benefit in that situation. And it's to go on with that example, if you started to lose 60% of your income, it would give you 60% of the benefit in that situation. So there's partial and residual contingencies combined with the proper definition of total disability. And now we're starting to get the package together that really is going to protect clients properly.
Okay. And what percentage of one's income should they be looking to replace?
That's a great question. A lot of people always hear about, and even in the industry, we talk about 66 2/3 of your income is the replacement percentage, but that's off your gross typically with a group
off
plan.
Off your gross income.
Exactly. So if you're making $100,000, 67% is about $67,000 of income replacement. But be aware of the maximum that might be in the group plan as well, which might say $5,000 a month. So $5,000 a month is only $60,000 a year. Okay. So the actual replacement percentage from a gross is 60%. But really what I try to educate my clients on is the net versus net. And what I mean by that is when you make $100,000 as an employee, you don't take $100,000 home as income because of our tax system. You might take home $75,000, right? So if you're taking home $75,000 and the disability benefit is non-taxable, the actual replacement percentage, if you divide 60,000 through by 75, you should be into about 80 to 85% income replacement from a net perspective. The higher income levels, that percentage insurers will insure less and less a percent the more money that you earn.
More tax and their net take home pays.
Exactly, but for clients that are making $500,000 or above, they won't actually keep it at 80%. It's a diminishing scale down into the 70 percentile, sometimes even down into the 60 and 50 percentile if you're really making a really, really high income.
Okay. And so then beyond the average employee that probably has an okay group disability plan and maybe a bit of a gap on both the monthly amount of their income that's being replaced and as well after 2 years, then you've got people that are self-employed. Yeah. People that are self-employed, typically, I can imagine there's a lot of people that don't have any disability coverage unless they've gone out of their way to seek it out.
Right.
Or they've talked to an insurance agent who has identified that risk, identified that concern, and talked to them about it. So those certainly are people that are at big risk.
Yep, absolutely. So, employees, a lot of times, like I said, advisors, if they have group LTD, they'll say, oh, you have group LTD, let's focus on the life insurance conversation, but that's not necessarily the right thing to do. Business owners, for sure, would be in the market for disability coverage because they don't have any income protection, but also professionals. Accountants, lawyers, I work with many of those clients, and they have access to association plans, which actually have very good, speaking in today's terms, very good definitions of disability, but it's all about what's guaranteed to the customer and what is at the discretion of the association and the insurer, because those plans are reviewed like a group plan every single year, whereas a personal plan is guaranteed from a definition and price perspective if structured properly.
And so then just to speak to that specifically, I would have to assume that if somebody was a lawyer, somebody was a doctor, and they were getting insurance coverage through the medical association or the law society, group, economies of scale, probably they'd be getting a good rate on their premiums. And I can imagine that most doctors and lawyers have their coverage through those professional associations.
Again,
but there is a gap, there is a hole.
Well, again, it's about education.
Potentially.
It's about education. Those association plans typically start at a very low premium when you're younger, and they go up automatically as you age. So the advantage to an individual plan is you can lock.
Which is strange. Well, I mean, I guess when you're younger, you've got more years of potential income replacement if you're disabled and you can't work for a long period of time.
But
As you get older,
the incidence rates,
you're more likely.
The incidence rates are higher in the older ages.
So disability insurance premiums will always go up as you age, or
well,
often?
With individual plans, you can guarantee the price to age 65 level. The association plans will take you through brackets, but the
brackets of ages, so
right,
30 to 35, 35 to 40.
Exactly, and the price will go up accordingly.
But it's not guaranteed up front.
Well, nothing about the program typically speaking are guaranteed. Price, definition, and to me this coverage is so important. It's important to guarantee this coverage for yourself and your family in the future.
Well, very important stuff that we're talking about here today, guys. Disability insurance, something that is often overlooked for Canadians. We're going to come back and talk about a couple of other different kinds of insurance. We're here with Chad and Jason. We'll be right back.
Animated by one supreme being, which is the God.
We don't do this in a sense of feminism, rather this is...
The interesting thing is that the political will seems to have come.
You can find it only in Jews and Palestinians.
A very good job at keeping it under control.
That liberating people who are thought to be unjust because of social, economic, or political conditions.
That time I thought it was so scary.
Officials,
everything you do.
When you know it, so you proxies of the.
Hi everybody, I'm Jason Heath. This is the Objective Financial Hour. We're here talking to Chad Larmond of Larmond Risk Management Insurance Incorporated. We've talked a little bit so far about the insurance industry, how it works. We've talked a little bit about disability insurance, a very important type of insurance for Canadians that's often overlooked. There are other types of insurance that are probably less talked about, less frequently sold, less frequently purchased by Canadians, and we're going to talk about those with Chad a little bit right now as well. Chad, I've started to hear a little bit more about critical illness insurance, whether it's clients who own policies or I met with a client yesterday where their employer was introducing a new group critical illness insurance policy. Hasn't been around for all that long, 25 years or so, I think, and probably less in Canada because it started off in South Africa, as I recall.
Yep.
Don't see a lot of those policies, don't know much about it, and I'm sure a lot of our viewers and a lot of clients don't know so much about it as well. What's critical illness insurance?
So starting with kind of the history of critical illness insurance, actually not a product that was designed or thought up by an insurance company. If you do some research or on one of the big search engines on the internet, you could easily find kind of where critical illness originated from. And really the brainchild behind critical illness insurance was a heart surgeon out of South Africa named Dr. Marius Bernard. And he was helping clients stay alive with these cutting-edge surgeries that he was performing, but he wasn't. When he was having the follow-up consultations with with his clients or patients, 6 months later, they would thank him, but they were struggling financially. So he went to some of the large insurers in where he was from and lobbied them and chatted with them about designing a product or coming up with a product that doesn't pay in the event just of death, but pays when you're diagnosed with a covered condition. It's evolved from there, and it started really in the UK, came over to the US, got into Canada, in the, I believe it was the early 90s, maybe slightly before that. But it's interesting where, to kind of learn about that background.
Yeah.
And like I said in one of the previous segments, it's funny that life insurance is so really the main product sold in the insurance industry, when critical illness is actually the much greater risk for Canadians in terms of statistically claiming prior to retirement years or age 65, and beyond that, there's even a high incidence beyond age 65.
And now, what is a critical illness?
A critical illness it basically is a covered condition in the contract. The main ones are cancer, heart attack, and stroke. Insurers these days are offering up to 25 covered conditions.
Wow.
But those
now,
three.
Do you have to go through and pick? Geez, these are the conditions that I'm worried about insuring against.
Good question. In today's market, you can buy a basic plan that just covers the risk of cancer, heart attack, and stroke, or you can buy the enhanced version, which is, in my opinion, most predominantly sold, where you've got between 22 and 25 covered conditions depending on the insurance company. But what you need to recognize is that 90% of the claims, 85 to 90% of the claims are made up, that the insurance industry experiences are made up of those three conditions, cancer, heart attack, and stroke.
Okay. And when I first started learning about critical illness insurance, I kind of thought, it seems to me like people need life insurance in case something happens and an income earner is no longer able to provide for her or his family. You need disability insurance if you're not able to work and earn that income, and likewise provide for your family. And critical illness, I always sort of thought was more like flip a coin. If I get an illness and I'm not able to work, my disability insurance will probably cover me.
Yeah.
If I get a critical illness and I die, my life insurance is going to cover me. But more and more, the way that I've started to look at critical illness insurance myself is not so much for the individual that develops the critical illness, that develops the cancer or has a heart condition or some other sort of affliction, but more for their spouse.
Right.
And I've talked to clients about envision the situation where one or the other of you is not able to work because you have cancer, you're going through chemotherapy, your disability insurance is replacing your income. The healthy spouse still has to get up every day, still has to go to work, still has to drop the kids off at school, isn't in a position where they have potentially much in the way of options. So I sort of look at critical illness as potentially a lump sum of money that individual could take, unpaid time off, or that they could use to fly to Japan and get some sort of a life-saving treatment or therapy.
Or closer in the U.S.
Or closer in the U.S. potentially. I was talking to somebody yesterday actually about a cancer treatment that their deceased wife had gone through in the UK, and heard a long story about what they went through with drugs that weren't available here, that they had to go to the UK to do it, cashed in their RSPs, and sort of a case study scenario, I guess, for critical illness insurance. So critical illness, I guess, is that the way that you would approach it, or how do you look at it as far as?
So just to pick up on what you said there, I mean, one of the main things that I've been talking to clients about is the fact that it really isn't an individual diagnosis when you're within a family unit. If you or your spouse were diagnosed with one of the covered conditions, cancer being the biggest, most commonly claimed for condition, it's not just the individual diagnosed that needs to deal with the consequences or the next, planning of 6 to 18 months or maybe longer of treatment and recovery. It's the whole family. So that money can be used, that flows in after 30 days, which is how the contract is set up, can be used to maybe pay for a leave of absence for the healthy spouse to really focus on recovery and really be a family unit at that time when it's most important. And if you look at studies, there's a really vicious cycle between illness and stress. So if there's a diagnosis, or even prior to a diagnosis, stress levels are high, there's a diagnosis, but then there's financial stress that creeps in because maybe the healthy spouse is having a difficult time at work, managing all the expectations and the new healthcare situation they have to deal with. That can cause further problems and just more financial stress. And that's where the lump sum benefit is designed to really, in my opinion, ease financial stress. You know, you can use the money as you please, but really it's a peace of mind of giving yourself financial flexibility when at a time you're going to need it most, without taking your retirement savings off of track, because that retirement savings, you don't want to use that money to fund a critical illness, because it's earmarked for, you know, if your future years. Yeah.
So when I look at the different ways to evaluate insurance, the insurance coverage that one should have, with life insurance, it's, I guess, relatively easy from the perspective that you can crunch the numbers, you can do a life insurance needs analysis, you can determine what the lump sum payment is today for that on the death of one spouse would ensure the family could continue doing as they had been doing. With disability insurance, you know, we talked about the fact that often it's replacing a percentage of your income.
Right.
With critical illness insurance, how do you pick that magic number?
So there's no
what the coverage should
there's
be.
no
It's a face value.
There's no exact science to it, but what I always talk to my clients about is a good rule of thumb is covering off 1 year's worth of your income.
Of your gross income?
Gross income is always better than net, but you know, between somewhere in that range of your 1 year's worth of your gross, 1 year's worth of your net is going to give you that ability to you know, fund your income for a year or a couple of years. You know, during that difficult time. So that's usually how I you know, initially show a proposal to a client, and then we kind of work it down from there or work it up from there, depending on the situation.
Okay.
And the client's personal preferences.
And there are some differences, I guess, as it relates to the premiums that you pay on critical illness insurance. Typically with disability insurance, or depending how you look at life insurance, you know, you don't really get your premiums back so much. With life insurance, I suppose, if you keep paying it when you die, somebody gets a portion of the premiums back in one regard.
Right.
But with critical illness, there are unique options to have a refund of the premiums that you pay.
Yep.
How does that work?
So I'll take it one step back for a second. There is actually features available today to go back to disability insurance. You can actually buy return of premium on disability.
Oh, really?
It's
so
not
you pay a higher premium.
It's a higher
along the
premium.
way.
It's not 100%. It's in today's market, it's 50% every 7 or 8 years. Yep. So I'll leave that just to kind of get it out there. But on the critical illness side, you can actually receive 100% of your money back at specified times in the future, but it's upon surrendering your coverage. So you'd actually have to no longer be insured, and then you take the money back out of the policy. And
does that mean canceling the coverage?
Basically canceling the coverage or canceling a portion of it. If you cancel the whole thing and you're eligible for that return of premium, you'll get 100% of your money back, which is really unbelievable. I don't think the return of premium feature will, as it stands today, will be around. Other countries like the US and the UK have gotten rid of return of premium completely on that product. So Canada,
and do you have a sense of why? I mean, it's difficult for them to
well, think about it. I mean,
the cost.
The insurance company, think about the interest rate environment, and you think about an insurance company taking your money and trying to make a return on it, but also guaranteeing you a payout if there's a claim, and then if there's no claim, giving you every single penny, less any interest, of course, but every single penny back to you as early as 15 years. I mean, it's I think it's a difficult thing to price actuarially, and you know, with the low interest rate environment. I
guess given how few policies there are as well, when you've got an abundance of life insurance policies, you've got more opportunity to determine what the odds are and what the risks are. If you have a couple of bad years with your critical illness policies.
But to be fair, critical illness sales have actually risen in the last few years, which is encouraging for me, kind of specializing in this area. It's something that I've been committed to for the last 10 years, and I own a policy on myself and my wife and even my daughter now with return of premium features, because it's a cash flow question. If the cash flow is there, I really like the idea, and a lot of my clients like the idea of getting their money back if they don't use it. It's really one of the only insurance policies that you know, allows you to do that when you think about the other insurances that we pay for.
Definitely.
Yeah.
And so I mentioned earlier the fact that I have seen a couple of critical illness options within group plans at work.
Yep.
Is that still fairly new as well?
I've seen it over the last 10 years that I've been in the business. I have seen group. It's becoming a little bit more common. Typically, the amounts that they cover their employees for are relatively low.
What are the increments in which one would buy critical illness insurance? Is it like 25, 50, 75, 100, or can you pick an exact?
You can pick an exact number. Generally speaking, the lowest amount a company would issue is $25,000, and the maximum amount is $2 million. So, I mean, depending on the client situation and their financial situation and their need, you can kind of determine something that's going to fit within that range usually. Yeah.
Well, that's great. I mean, I think it's very interesting and very refreshing to speak to somebody that's going out of their way to work in a more specialized part of the insurance industry. I think it's probably a part of the insurance industry that you really need to be an expert and a specialist to do a good job, identify risks, explain options to clients. And oftentimes I look at the insurance industry and think it's set up mostly for life insurance sales and just keep it simple, sell your policy, move on to the next person. So the fact that you are taking maybe the more difficult path as far as what you're doing, you need to educate clients in the first place to have an opportunity to do your job well.
Sorry to interrupt, but the one thing I will say is these products, because the incidence rates are so much higher, the incidence rates of being disabled or being sick while you're working when people are buying these insurance products, it's a much more difficult product to qualify for than, say, term life insurance or even permanent life insurance.
So you might go through the process, or the agent might go through the process and not make a sale, so not a good use of their time potentially.
Yeah, well, and I think that's part of that could be part of the reason that advisors stay away from it. But a good advisor, a good insurance broker, will work with you to get all your medical information, or as much as possible, and work with the insurance company to make sure that you've got all the information, or they've got all the information, they're making an offer, and you're getting the best offer that you can for your client, if an offer is possible. Some people simply won't qualify based on pre-existing medical history, but just wanted to make that distinction. It is more difficult, and it takes a little bit longer to get a policy issued, usually between 1 and 3 months, versus life insurance that might be between a couple of weeks and a month and a half type of thing. So,
so maybe a little more work for you, maybe a little more work for the client.
Yeah.
Well worth it from the sounds of it, and I think that's one of the reasons that I wanted to have Chad here today, talking to us about the insurance industry, talking to us about disability and critical illness insurance, which are very important and often overlooked. Chad, I appreciate your time today.
Yeah. Thanks for having me.
Chad Larmond from Larmond Risk Management Insurance. I'm Jason Heath, your host with the Objective Financial Hour. It's been a pleasure, and we'll see you soon.